I'm Chandra, better known as the Virgin Trainer. Welcome to the Miracle Millionaires Hive Learning Hub, where we make learning the crypto space simple. We're here to educate, train, and empower. So let's learn, verify, and grow together. The future economy, understanding AI, digital payments, digital assets, and blockchain. Welcome, and thanks for taking the time to watch this. Wherever and whenever you're catching this, I want to walk you through something that genuinely matters right now. 5 forces that are actively reshaping how money and ownership work. AI, which is artificial intelligence, digital payments, blockchain, nodes, and digital assets. I want to be upfront about what this is and isn't. This isn't me predicting the future. Nobody can honestly do that. What I can do is show you what's already changed. Back it up with real numbers, not guesses or hype, and help you understand it well enough to make your own informed decisions. That's the whole point of the next half hour or so. So let's get into it. While we're here, here's the honest starting point, and I want you to actually hear this. You do not need to become an expert in any of this. Not in AI, not in blockchain, none of it. Nobody watching this needs to. What actually matters is understanding the shift enough to make informed decisions. How you bank, how you get paid, what you choose to own. That's it. That's the bar. I say this because a lot of content out there about this topic is designed to make you feel behind, like everyone else already gets it and you're playing catch up. Well, that's not true, and it's not helpful. The pace of change right now really is faster than most people are used to. But that's exactly why slowing down and building a clear, plain language understanding matters more than chasing every headline. So today we go slow, we go clear, and by the end you'll have a real foundation, not just a list of buzzwords. Yesterday, today, tomorrow. It helps to see this as a line, not a jump. So let's walk it. Yesterday, for most of modern history, this meant cash, checks, paper records, physically walking into a bank branch to move your own money. That was the entire system for generations. Today, most of us are already living in the middle column without even thinking about it. Mobile banking, AI assistants answering our questions, digital payments instead of cash, and a growing number of people already hold some cryptocurrency, whether they think of themselves as crypto people or not. Tomorrow is really just the next step down that same road, not a sharp turn. Artificial intelligence woven further into daily life, digital assets, tokenization, blockchain infrastructure running quietly underneath things we already use. Here's the thing I want to land on in this slide. None of this is as foreign as it sounds when you lay it out this way. We're not being asked to leap into something alien. We're already halfway there. We've just been calling the pieces by different names. What is AI? Let's start simple, because AI gets talked about like it's mysterious, and it really isn't. AI is software that can learn, answer questions, and help people work faster. That's the actual definition, not science fiction, not a robot uprising, just software that gets better at tasks the more it's used and trained. Now here's where I want to bring in real numbers, because this isn't some far-off hypothetical technology. ChatGPT alone now has around 900 million weekly active users. To put that in perspective, that's more than double what it had just 1 year earlier. It took Instagram 2.5 years to reach 100 million users. ChatGPT did it in about 2 months. Nothing in consumer technology history has scaled this fast. And this isn't just casual chatting. McKinsey's own research found that 71% of organizations now use generative AI in at least one part of their business. Not plan to, already do. This has moved from experiment to infrastructure in a remarkably short window. So when I say AI already helps people save time, write, analyze information, and automate repetitive work, that's not a sales pitch. That's just where things already stand. And I want to be really clear on this next point. This isn't about replacing people. It's about helping people work smarter. The organizations getting value from this aren't cutting their teams. They're removing the repetitive parts of the job so people can focus on the parts that actually need a human. Slide 5, AI in your pocket. Let's make this concrete, because I guess Most of you watching have already used at least one of these three tools, whether or not you thought of it as AI at the time. ChatGPT from OpenAI, built for writing, research, and answering questions in plain conversation. It's the one most people picture when they hear the word AI these days. Google Gemini, built directly into search, Gmail, and Android devices. If you've used Google at all recently, there's a real chance Gemini has already touched your day without you consciously opening an app for it. And Siri, Apple's voice assistant, this one's worth pausing on because Siri has actually been on the iPhone since 2011. That's over 15 years, long before anyone was talking about an AI boom. Most of us already had a basic AI assistant living in our pocket. The technology didn't arrive overnight. It's been quietly maturing for over a decade, and the last few years are really about it becoming dramatically more capable, not about it appearing out of nowhere. Here's a number I think is genuinely important. 1 in 4 employed Americans now use ChatGPT specifically at work. That's up from just 8% back in 2023. That's a tripling in roughly 2 years. Here's a number I think is genuinely important. 1 in 4 employed Americans now use ChatGPT specifically at work. That's up from just 8% back in 2023. That's a tripling in roughly 2 years. This has moved from things some tech people use to a normal part of a huge portion of the workforce's actual day extremely fast. What are digital payments? Digital payments are payments made electronically instead of with cash or a check. Money moving through a phone, a card, a digital wallet instead of paper changing hands. Let's talk about why this is growing, because the scale here is honestly larger than most people assume. The global digital payments market is projected to process 26.89 trillion in transactions in 2026 alone. To give you a sense of how fast that's grown, the figure was just 1.7 trillion back in 2014. That's roughly a 15-fold expansion in 12 years. And it's not slowing down. It's forecast to keep growing at around 7.6% a year, reaching over $36 trillion by 2030. Why is this happening? A few real reasons. More people are online than ever before. That's just baseline fact of modern life. It's faster and it's more convenient than cash or checks. Nobody's arguing that point anymore. The technology behind it keeps getting more secure. Fraud detection has genuinely improved, and frankly, businesses prefer it too. It's faster for them to receive payment and reconcile their books, which matters more than people realize on the business side of this. Globally, digital wallets now account for 53% of all online purchases, more than double the 20% still going through credit cards directly. That's a real shift in how the world actually pays for things, not a prediction, a description of right now. Slide 7. Payments you already use. Apple Pay, Google Pay, Venmo, PayPal. Chances are genuinely high you've got at least one of these on your phone right now, maybe all 4. Let's put some real weight behind that. Apple Pay alone has around 818 million users worldwide, and it's accepted by over 90% of U.S. retailers, available in 95 countries. Venmo specifically processed $342 billion in total payment volume. Not user count, actual dollars moved through the platform. Here's why I'm spending time on this slide specifically. Every single one of these apps moves money without cash, without a check, without a trip to a bank branch. And that's exactly why blockchain-based payments and digital assets won't feel as foreign to people as they expect once they actually encounter them. We've already collectively made this exact shift once, from physical money to digital money moving through an app on our phone. The next shift, digital money moving through a blockchain instead of through a single company's servers, is a smaller conceptual leap than it sounds like, because we've already proven to ourselves that we're comfortable trusting our money to a screen. Slide 8. Section divider. Blockchain, nodes, and digital assets. Now we get into the part that trips people up the most. Blockchain, nodes, and digital assets. This is usually where people either check out because it sounds too technical or get pulled in by hype without really understanding the mechanics underneath it. I want to do neither of those things with you. I want to slow down here and build this piece by piece in plain language, because once it actually clicks, it really clicks and you stop needing anyone else to explain it to you again. Slide 9. What is blockchain? Blockchain is a digital record book shared across thousands of computers at once instead of sitting on one company's servers. Here's how to actually picture it. Imagine a notebook where every transaction ever made gets written down. Now imagine that instead of one bank holding the only copy of that book, 10,000 different computers around the world each hold an identical copy, and they all check each other's work constantly. Everyone sees it. Everyone verifies it. Everyone keeps their own copy. That's the entire mechanism, and it's what makes blockchain hard to fake or quietly alter. If someone tried to change one entry in their copy, it wouldn't match the other 9,999 copies, and the network was simply rejected. This matters because there's no single company or bank sitting in the middle that you're being asked to trust. The trust doesn't come from a brand name or an institution's reputation. The trust comes from the math and the sheer number of independent copies all agreeing with each other. That's a genuinely different foundation than how traditional finance has worked for centuries, and it's worth sitting with that difference for a second before we move on. What is a node? A node is just a computer that helps verify information on that blockchain. Think of it like a referee at a game, making sure every transaction actually follows the rules before it gets accepted. There are different kinds. Some nodes store the network's entire history, every transaction that's ever happened going back to the very beginning. Others just verify transactions quickly without holding everything. They're built for speed rather than full storage. Together, this is what makes the whole system secure, resistant to any one point of failure. If one node goes offline, or 10 or 1,000, the network as a whole keeps functioning because no single node was ever the one thing holding everything up. That resilience isn't an accident. It's an actual design goal, and it's the reason this architecture has held up under real-world stress for over a decade at this point, rather than being purely theoretical. Slide 11. What is cryptocurrency? Cryptocurrency is digital money that moves online without needing a bank to process it. Bitcoin and Ethereum are the names you've almost certainly heard. They're the two biggest. Here's the analogy I keep coming back to. Email changed how we send letters. It didn't change the idea of writing someone a message. It changed the mechanism underneath it, and it did it that so thoroughly that most of us barely remember what the old way felt like. Cryptocurrency is doing the same thing to how value itself moves online. Some underlying need sending value to another person. Fundamentally different mechanism underneath. And this has already moved well past the early adopter phase. Roughly 30% of Americans now own some form of cryptocurrency. That's not a fringe number anymore. That's approaching a third of the country. This isn't a niche interest confined to one corner of the internet. It's become a mainstream financial behavior, even if it's still relatively new compared to how long we've been using banks. Slide 12. What is tokenization? Tokenization means turning ownership of something into digital pieces that can be tracked on a blockchain. Let's make this concrete. Picture a building worth $1 million. Normally, one person or one entity owns the whole thing, and if you wanted a piece of it, you'd need a huge amount of capital just to get in the door. Tokenize that same building can be split into 1,000 digital ownership pieces, each one trackable, each one transferable, each one small enough that far more people could actually participate. I want to give you real numbers here because this has moved from theory to actual, measurable market. The tokenized real-world asset market has gone from around $5 billion just a few years ago to over $30 billion in on-chain value right now. That's roughly six-fold growth in a short window. And where is this heading? Forecasts vary quite a bit depending on who's doing the projecting, which is actually worth noting, honestly, rather than picking the most exciting number. McKinsey, generally the most conservative major voice in the space, projects around $2 trillion by the year 2030. Boston Consulting Group's estimate runs considerably higher into the trillions as well on the aggressive end. Even the most cautious of these projections represent represents massive growth from where the market sits today. I'd rather give you the honest range than just quote you the biggest headline number, because the honest range is still a genuinely compelling story on its own. Slide 13. What is a smart contract? Think of a vending machine. You put money in it. The machine checks it. You get your item. No person has to process that transaction in between. A smart contract works exactly the same way, but for digital agreements. It runs automatically the moment its conditions are met. No middleman required to approve it. This isn't a small experimental corner of the crypto world either. Tens of billions of dollars currently sit in smart contracts across decentralized finance platforms, the bulk of it running on Ethereum specifically. That figure moves around a lot. This space is genuinely volatile, and I want to be honest about that rather than pretend it's a smooth, always up chart. But even accounting for that volatility, we're talking about a real functioning financial system running entirely on self-executing code, not a hypothetical use case someone's still trying to prove out. Why decentralization matters. This is really the thread tying everything we've covered together. No single company or person controls the network. Thousands of computers share the same record, so the system keeps running even if some of them go offline. And no single party can quietly change the rules on everyone else, because changing the rules will require convincing thousands of independent operators to agree, not just flipping a switch at company headquarters. Compare that to a traditional bank's database. If that one system goes down, or if that one company decides to change a policy overnight, everyone relying on it is simply affected with no real recourse in the moment. A decentralized network doesn't have that single point of failure baked into its design. That's not a minor technical detail. It's the entire philosophical shift this whole space represents, moving trust away from any one institution's promise and into a system where the trust is structural. Slide 15. Regulation and compliance. I want to be upfront about this part because it matters, and because I think glossing over it does everyone a disservice. Rules vary by country, and they're genuinely still evolving. This isn't a settled, finished rule book anywhere in the world. Reputable platforms follow know your customer and anti-money laundering standards. The same kind of identity and activity checks a traditional bank already runs on you, just applied to this newer kind of platform. Regulation exists to protect users, not to slow down real legitimate innovation. And I push back gently on the idea that those two things are naturally in conflict. Understanding the rules is genuinely part of understanding the opportunity here, not a separate, boring compliance footnote to skip past. Slide 16, the CLARITY Act. Let's get specific about the U.S. because there's real concrete movement happening right now, not just talk. The CLARITY Act passed in the House back in July 2025 with a strong bipartisan vote, 294 to 134. I want to underline that part because so much of what gets covered in the news makes this space sound politically divisive, and this particular bill genuinely was not. What it actually does is split regulatory oversight. The CFTC will regulate digital commodity markets, while the SEC keeps its existing authority over securities. That distinction matters more than it sounds like, because a huge amount of the legal uncertainty in this space has come from platforms not knowing which regulators' rules actually apply to them. As this was recorded, the bill had cleared committee in the Senate, but still was waiting on a full floor vote. If you're watching this later, it's generally worth doing a quick search to check where things stand now, since this is exactly the kind of thing that can move while recording like this keeps playing. Here's why I think this is a good thing. Not just a neutral development. Clear rules mean less legal gray area for platforms to operate in, and clear protection for users like you. Regulatory clarity tends to be what unlocks the next wave of serious, cautious money entering a space, precisely because the biggest, most risk-averse institutions won't move in size until they know exactly what rules they're playing by. Wall Street is already building on this. This is the slide that tends to surprise most people, so let's sit with it. BlackRock is the world's largest asset manager. Not a crypto company, not a startup. The single largest traditional asset manager on the planet, managing around $14 trillion. And they've launched BITL, their own tokenized fund running on public blockchains, the same underlying technology we've been talking about this entire time. Larry Fink, BlackRock CEO, has compared this current moment to 1996, the very early internet, before most people understood what it would become. In his own words, half the world already carries a digital wallet. That's not a crypto enthusiast talking. That's the head of the largest asset manager in traditional finance. I want to be really clear about what this means and doesn't mean. It doesn't mean everything in this space is automatically safe or guaranteed to succeed. That's never true of any emerging technology, and I'm not going to stand here and tell you otherwise. But it does mean this has moved well past being a fringe idea. When the most conservative, risk-averse institution in global finance is actively building infrastructure on this technology, that tells you something real about where serious, sober analysis has landed, not just where the hype has landed. So let's recap where we've been. AI, already mainstream, already in your pocket. Digital payments, a $26 trillion global system you're probably already part of. Blockchain and nodes, the infrastructure, making all of this verifiable without a single company controlling it. Digital assets, cryptocurrency, tokenization, smart contracts, all moving from theory into real measured market. And the regulatory and institutional picture genuinely maturing with the greatest names and largest names in traditional finance already building here. None of this required you to become an expert today. That was never the goal. The goal was for you to leave this with a clear, honest, plain language understanding of what's actually happening, backed by real numbers, not hype in either direction. That's it for this video. If this resonated and you want to dive deeper, fill out the form in the description to join a session where we'll walk through the different ways you can earn here. Thanks for watching.